Joining us now with more on what to expect from the semiconductor bellwether, Apjit Walia, senior semiconductor analyst at RBC Capital Markets. He raised his estimates for Intel's first quarter results today, but he rates the shares merely a sector perform, but feels pretty positively about them. Eric Ross is director of electronics research at ThinkEquity. He rates the shares a buy. Gentlemen, welcome to you both.
Thanks for having us.
Thank you.
Mr. Walia, thank you for joining us today. Give us the framework of the numbers. What is the consensus, and what do you think Intel's likely to say when they come out after the bell today?
Well, the street's numbers have gone up a lot the last couple of months. They've gone around 9.1 billion. We raised numbers on Intel around November and then again in December to a street high of 9.3. We raised them again today to 9.45, so it's considerably above the street numbers. We have a long-term sector perform, of course, because of the desktop issue, but near-term we've been recommending the stock for the last 4 months very aggressively. We expect them to raise the midpoint slightly today, because usually Intel's relatively conservative in the mid-quarter update. But our checks today, as of this morning, are showing that desktop has also started to pick up. We've been seeing strength in notebooks and Centrino for the last few months, but now even desktop seasonality is going away and seeing strength there. So I expect them to go to as high as 9.45 when the quarter closes. And I've also raised my EPS number to 30 cents. That's 2 cents above consensus.
Mr. Ross, react.
Well, I think that's definitely the right direction. I think it's a little bit higher than what we would have expected. We actually just raised our expectations to 9.2 billion from the midpoint of the range, 9.1 billion, about 2 weeks ago. We think that 9.4 billion might be a little bit ahead of things. If they do that, I think the stock is going to be up considerably. If they just do the 9.2 billion that we have in the stock right now, again, we have a buy rating on it, we think the stock's going to react about flat with the 9.2 billion and 28 cents.
How about the margin number, Mr. Ross?
We have 55% built into our March quarter. We think it could be a little bit higher. We're not expecting to see it a lot higher. Don't forget that there's a lot of spread when they give us a guidance. They say 55% plus or minus a couple of points.
Mr. Walia, you in that sort of area, 55, 56%?
No, I'm higher. I'm at 56%. I expect more upside. I think the margin mix is tracking higher than most people expect.
So why isn't this stock performing if the business is?
I think that's one of the best stocks in semiconductors this year. If you run semiconductor performance since year to date, it's one of the top 4 stocks in the sector. It's significantly outperforming the rest of semis right now, and I expect it to continue.
And yet, why you merely call it a sector perform, but you feel that means, a sector perform with average risk. Why do you give it that rating and not something more?
Sure. I mean, I get that question a lot. My long-term rating, it's about 18 months, 24 months rating. I mean, I'm still concerned about second half of the year. Let me give you a bit of history. We upgraded the sector in September, but most of the sell side was very bearish, and we called for a beta trade. And since the beginning of the year, we're recommending people play high-quality names. The reason I have a sector performance is because I still think, as most of my peers have upgraded the sector the last 1 month, I think sentiment will get too bullish on semis. And second half of the year, GDP demand is still questionable, where semiconductor growth might not be as high as people expect. So I think near term, I expect the stock to continue to outperform just the way it's been doing for the last 2 months. But as we get into the third quarter, the next few months from now, I'm a little worried as sell-side sentiment has gotten very bullish.
Have to leave it there. Mr. Walia from RBC, thank you very much. And Eric Ross of ThinkEquity.
Thanks,
gentlemen, again, for being with us today. Now that